Take a look at this. So you see this price action sequence. You see this trend line. You wait for the breakout below it. And you enter when price closes below it. And what do you know? Price returns to the trend line and continues in the initial direction. Sounds familiar, right? Trend lines are the simplest tools in technical analysis and may be the hardest setup to trade, much harder than a classic support or resistance level. In this example, I see maybe 4 or 5 reasons of why you shouldn't have taken this trade in the first place. If you're guilty of making the same mistake, get ready to take some notes because you're about to discover the keys to mastering trend lines and how to make the most of your trading strategies. So like, subscribe, and stick around for the full video. Drawing trend lines without wicks is, in my opinion, a better approach because it eliminates noise. A wick is the highest or lowest price that was reached during the period represented by that candlestick, a rejection of price. When you draw a trend line using the wicks of the candlesticks, you are including prices that were not maintained during that period, and this can lead to more false signals and a less accurate trend line. For example, if you draw a trend line using the wicks of a bullish candlestick, the trend line will be a bit lower than if you draw it using the body of the candlestick. This difference may not seem significant, but it can make a big difference in the outcome of a trade. When you have a large wick on one side of the candle, it could indicate that the price got rejected in that level. This could be a sign of a potential reversal. But if you are drawing your trend line with the wicks, you might be taking that large wick as a valid price point, leading you to a false conclusion. So start drawing trend lines using only the body of the candlesticks. A big mistake I've personally made for several years is to focus on the trend lines that connect only 2 points. You see 2 swings and you connect them with a trend line. I've lost far too many trades chasing false breakouts using this technique. When drawing trend lines, the more connecting points, the better. This is because the more connecting points a trend line has, the more reliable and robust it becomes. A trend line with more connecting points is more reliable because it has been tested against more price swings and has been able to withstand those tests, indicating that the trend has momentum and is likely to continue. If you have a trend line connecting 2 points, it can be considered as a weak trend line, and let's face it, it can be easily broken. But if you have a trend line connecting 3 or 4 points, then you have a strong trend line. When you see a clear breakout from a strong trend line, it means something. The point is, when you are drawing a trend line with only 2 points, you could be seeing a coincidence, but when you have a trend line connecting more points, you can be sure that the trend is real and it has been established over a longer period of time. So price is constantly changing, impacted by volatility and momentum. This is particularly relevant when analyzing trend lines. Professional traders are very aware that amateurs are likely to place trades around trend lines and will often manipulate the market to cause the price to spike, then change direction. To improve your win rate, it can be beneficial to use areas rather than relying solely on single trend lines. For example, when using a single trend line, you may be hesitant to enter a trade if the price is just slightly above or below this trend line. However, by using an area, you set a range of prices where the market is likely to find support or resistance. Here's a quick tip on TradingView. First, you draw the trend line, connecting the swing lows. Then you hold the Control key and drag the line to form the area. This can give you a bit more wiggle room to enter or exit a trade. By creating these so-called noise zones, you can filter out a significant amount of market noise and eliminate the need to draw trend lines precisely at the highs or lows. The distance between connecting points is crucial when determining the validity of your trend line. When forming an uptrend line, the swing lows should not be too far apart or too close together, as this can question the validity of a future reaction. Similarly, when forming a down trend line, the swing highs should also be relatively evenly spaced. There isn't an ideal distance between these points. It will depend on the time frame you're analyzing. It's important to measure the time passed between consecutive touches of a trend line. Here's an important tip. A shortening time between touches can indicate a potential breakout. When the market repeatedly tests a trend line over a short period and the price stays close to the trend line, it is likely that a breakout will occur and the trend may be reversing. Though this is not always the case, this pattern can indicate a good opportunity for trading a breakout rather than a continuation play. The slope of a trend line can impact its validity as a support or resistance level. Let's say we have a chart with price that has been steadily increasing over time. As the price rises, you can draw a trend line connecting the lows. This trend line will have a relatively shallow angle, indicating that the price has been rising at a steady and consistent pace. This trend line can be considered a reliable support level, and it's likely that the price will continue to find support around this level. Now let's say that the price suddenly experiences a sharp and rapid increase. If we were to connect the lows during this time, the trend line would have a much steeper angle. This sudden and sharp increase in price is not likely to be sustained, and it's less likely that the price will continue to find support at this level. So, as the angle of the trend line becomes steeper, the reliability of the level decreases. In fact, a steep trend line is often the result of a sudden and significant price movement over a short period of time. Such trend lines created from sharp moves are less likely to provide a meaningful support or resistance level. Even if the trend line is constructed with many valid points, attempting to profit from a trend line break may prove challenging. There's a special appeal to trade a trend line breakout. I don't know why, but many new traders prefer to wait for the trend line to be breached, then trade the potential breakout. I've also been guilty of this mistake, and now I can tell you that trading in the direction of the trend line is a more consistent strategy than trading breakouts. This allows you to ride the trend and take advantage of the momentum that is already present in the market. For example, let's say that you have identified an uptrend on a chart and you have drawn a trend line connecting the lows of the price. It's better to trade in the direction of this trend line, meaning you would be buying when the price is approaching the trend line. You want to capture the upward momentum of the market and not wait for a breakout, which it may not be valid in the first place. Another advantage of trading in the direction of the trend line is that it allows you to place stop losses below or above the trend line, providing a clear level of risk management. Not too close though, because you don't want to be the victim of stop loss hunting. Many traders are drawing a trend line, and at the first candle close below it, they enter right away. But the first retest after a trend line breakout is a much better area to take trades from. So why is that? A big number of traders will place trades in the direction of the trend line. When the market moves below it, then all of the traders who have placed buy trades at the trend line are trapped in losing positions. Their biggest desire when the price is below the trend line is for market to return to their entry level. A lot of buyers will wait for a break-even chance to close their positions. Different traders will decide to close their trades at different times, and the closer the market gets to the breakout point, the higher the number of traders who will be closing their trades. That's why you'll see an immediate reaction when the price returns to the trend line. The losing traders had their chance to exit their trades. Buyers are exiting, more sell orders are coming into the market, and this adds momentum to the downside. In many cases, when you wait for the first retest, you will get a better price to enter. I personally trade only the first retest and ignore the following tests. I have one rule: the breakout level can only be touched once. When a level has been hit once, its significance in the market decreases dramatically, and the chances of the market reacting to the level in the same way again is low. If the market returns to the trendline breakout area again after already being touched, the traders who went short on the breakout may not be in their trades anymore. Traders will not sit and watch as their profit on their trades gets smaller and smaller. They will always close their trades while they still have a little bit of profit left. At the second or third retest, you could be facing a lack of orders in the market, so focus on the first retest. Trend lines on the higher time frames are considered to be the most significant. For instance, a trend line that extends over a 2-week period will always be considered more important than one that only extends over the course of a trading session. To achieve the best results, it's better to use higher time frames. It increases the reliability of the analysis. For example, let's say we're looking at a chart and we've drawn a trend line on the daily time frame. This line represents the overall direction of the price over the past few weeks or even months. Now, if we switch to a lower time frame, like the 15-minute time frame, we may see that the price is also following an opposite trend line. But when you're looking at the 15-minute trend line, you're only seeing the price action over the past several hours. The trend line on this chart is more likely to be influenced by short-term factors. Which one has more relevance? It's the higher time frame one. There is more data, more candles that are used to make the trend line. This makes it more reliable, and it's less likely to be affected by the short-term volatility. One of the main things to remember when trading trend lines is that using an approach that utilizes multiple confirmations is generally the best way to go. The more confirmations, the less chance of a false signal. It's always helpful to look for confluences in your chart, which is when multiple signals point to the same conclusion. One example of this is when a trend line aligns with a long-term moving average. Let's say we're looking at a chart and we've drawn a trend line on the hourly time frame. This line represents the overall direction of price over the past days. If we add a moving average to the chart, we can see that the price is constantly bouncing off the moving average line, which also confirms the trend line. Another example is when the price is consistently trading above the moving average line and the trend line is also pointing upwards. It gives you a better indication of the bullish trend. When a trend line aligns with a moving average, it provides a level of added confidence in the trend direction, as it confirms the trend line and can increase the reliability of your analysis. When these indicators give conflicting signals, you have a warning sign, and it's better to wait for further price action to unfold. So, like I said, trading trend lines is much harder than trading classic support or resistance levels. If you want to have the full picture, you definitely must watch this video. And check out our Academy program if you want to further level up your trading. Until next time.